No.
They didn't seem very happy. All right, well, we address common financial planning questions in Money Tuesday today, and our expert and regular guest, Stewart Welch, with us once again. Good to see you.
Good morning.
All right, so today we are focusing on some of the questions that you have gotten from folks that you talk to, see you on TV, and then read your column. And so we start with the first one here. What are the current tax rules regarding the sale of one's residence? And so what was the question within that? What was their concern?
So really, you know, people sell their home and they go, am I going to owe taxes? And this person was just, I don't really understand the rules. And it's pretty confusing, I think, to a lot of people. The rules have changed over the years. So I think there's good news for most people. And the answer is, if you're single,
right,
filing a single tax return, then you can exclude up to $250,000 of profit on the sale of your home. So that's good news.
Okay.
If you are married, you get to double that. It's $500,000 of profit. So if you had a house for $200,000 and it grew in value to $400,000 and you sold it and you're single, there's not going to be any tax on that.
Okay.
If it was $475,000, then you're going to have some tax. It'll be taxed at capital gains rates. So that's good news for most people. Now, you know, a lot of people have held their house for 30 years and they may exceed those kind of numbers. And to the extent that you exceed it and there is a profit, that profit is going to be subject to long-term capital gains tax. And there is, the one catch is there is an ownership and use test. So when you sell it, you have to have owned it and used it as your primary residence for 2 of the last 5 years. So that's, if there's going to get hooked, if you're going to get snared by taxes, that might be it.
Okay, so you just need to look at that before and maybe delay on selling the house.
If you fall into that category. Most people don't, but if you do, you need to be careful.
All right, let's look at the next one. Now this has to do with the person's mother passed away, and so they had concerns about bank accounts and those type of things.
Okay, so in this case, she actually had not passed away. They were trying to figure out how to avoid probate. So probate's everybody wants to avoid probate. It's a
so they're
real
planning
hassle.
before the mother
they're saying,
passed away.
how do I do this? And particularly in this case, how do I do it with the home? Because the home was in the mother's name.
Okay.
And actually the home was in the mother and the deceased father's name. And they were talking about doing a trust and should I do all this kind of thing. Real simple. You can go in and have your name as a child, have your name added to the deed. So it would be a joint title with the parent. That way when the parent dies, it automatically transfers to the child.
There's no question.
There's no question about that. So what's really important though is you have to avoid probate, you have to make sure all the assets are going to avoid probate. And the easiest way to do it is make a list of all your parents' assets and then trace how do I get them from them to me without going through probate. So for a bank account, you can set up what's called a payment on death account. It's like a beneficiary designation. It's called a POD. And that way it'll automatically transfer. Well, Janice, you have to do that for every asset. If you miss one, that asset may be subject to going through probate, and that's what you're trying to avoid.
Okay, and when your heart is broken and you lose a loved one, those are the kind of things you don't want to deal with, so dealing with them ahead of time is a good idea.
It makes life a lot easier, sure does.
Good to see you. Thanks so much.
Jan.
All right, still